Okay, let's unpack this. You've brought us some truly fascinating material today. Snippets from Unlocking Bitcoin Wealth, Strategies and Risks. And our mission, as always, is to extract the most important nuggets of knowledge for you.
Mm-hmm.
We're about to plunge headfirst into the intriguing world of Bitcoin and the perennial pursuit of wealth within it. Get ready for some eye-opening insights that go beyond the headlines.
Indeed. Our deep dive today is all about exploring the various strategies for engaging with Bitcoin, from direct investment and active trading to more indirect methods.
Right.
And critically, what you need to be on the lookout for as you navigate this rapidly evolving space. We aim to move beyond the sensationalism and give you a true, grounded understanding.
Yeah, cut through the noise a bit.
Exactly. This entire deep dive is designed to be your shortcut to being genuinely well-informed on a complex, often misunderstood subject. It's about providing clarity and actionable insights, making sure you grasp not just what these strategies are, but why they matter and what profound considerations you need to weigh before taking any step.
Mm-hmm.
We want to arm you with the critical thinking tools to dissect the opportunity and, well, the inherent challenges too.
Absolutely. And to truly grasp the allure, I think we have to start with a look back, because Bitcoin's journey is, well, it's nothing short of remarkable.
It really is.
Imagine, if you will, a time machine set to 2015. Back then, this cryptocurrency, which now dominates so many financial conversations, was hovering at a humble price point of around, what, $200?
Just $200, yeah. It sounds almost unbelievable now.
Right. It was definitely a niche interest, mostly for, tech enthusiasts and the really early adopters.
And then fast forward to when our source material was written and the contrast just became stark. That same asset had soared to an all-time high above $18,000
$18,000.
from 200.
That's not just growth. It's an explosion in value. For those tracking its trajectory from the very beginning, this represents a staggering return.
Staggering is the word.
The source unequivocally states that such growth could make you very rich indeed, reflecting a more than 90-fold increase in value over, about a decade? For those who recognized its potential early on.
Wow.
And what's truly fascinating here, I think, is that despite its well-documented wild swings, those dramatic peaks and troughs that often grab headlines.
Oh, yeah, the roller coaster?
Exactly. The underlying narrative for Bitcoin has been one of consistent long-term growth. It's similar in many ways to the broader stock market, right? Where individual companies or even entire indices can experience significant volatility year to year. But the broader market over decades tends to move upward, driven by innovation, economic expansion, all that stuff. Makes sense.
And the source explicitly notes that, like stocks, Bitcoin has experienced volatility through the years, but its long-term trajectory has always been up.
Yeah.
This historical performance, this undeniable upward trend despite the turbulence, that's precisely why so many are captivated by its potential. It's why we're having this conversation today.
Yeah.
It fuels the belief that despite the sometimes scary ride, the destination is significantly higher.
I mean, a 90-fold return.
Yeah.
It almost makes you want to invent that time machine back to 2015, doesn't it?
Uh-huh. If only.
That kind of, if only I knew then what I know now moment we all dream of. But, okay, that's the past. What about the future? Our source mentions some truly, eye-watering predictions, almost science fiction levels of potential, right?
Yes, it does. And these forecasts are certainly attention-grabbing. The material highlights that some experts have suggested Bitcoin's price could reach $200,000, $500,000, or even higher.
$500,000 per Bitcoin.
Yeah. These are, of course, projections based on various complex models and assumptions about, global adoption, the impact of its program scarcity, evolving market demand. Lots of factors.
Sure.
They paint a picture of a future where Bitcoin plays an even more central role in the global financial system. However, and this is crucial.
There's always a however.
Always. It's also crucial to remember the inherent difficulty in predicting market movements with absolute certainty. The source is very clear on this point, stating it's all but impossible to predict when an asset might have peaked.
Okay, so grounded in reality, too.
Exactly. It acknowledges the speculative nature of such forecasts. No one has a crystal ball, right?
Nope. Yeah.
Yet that long-term upward trajectory observed historically does provide a significant foundation for these optimistic outlooks. It's not just blind speculation, it's kind of extrapolation based on a decade plus of performance and underlying economic fundamentals. So this raises an important question for you, the listener. What combination of factors could realistically drive that trajectory towards such ambitious figures? And maybe more importantly, how does one position themselves within such a dynamic and unpredictable environment to potentially benefit?
Hmm.
The sheer allure of these potential future gains is precisely why people are exploring the strategies we're about to discuss, seeking to capture a piece of that perceived future value.
Yeah, it makes sense why people are interested.
It's about understanding that while past performance doesn't guarantee future results, it certainly fuels the interest and investment in these approaches. And that very promise of, exponential growth drives continued innovation and investment in the underlying infrastructure, mining, exchanges, everything.
Yeah.
It further cements Bitcoin's place in the financial landscape.
Okay, so we've charted Bitcoin's astonishing rise from like an obscure digital curiosity to a global phenomenon, a journey that's really rewritten the rules of wealth creation for some. Now, as the dust settles on its past and the buzz of its future predictions fills the air, the fundamental question becomes, how do individuals truly engage with this digital frontier? Our source material lays out 4 distinct pathways, each demanding a different mindset and approach. Let's unravel the first one, the one that historically has rewarded patience above all else.
The classic.
Yeah, the first strategy, and one that resonates deeply with long-term investors across, virtually any asset class, is the buy and hold approach.
Simple but effective, potentially.
Exactly what it sounds like.
Yeah.
You acquire Bitcoin, and then you simply hold on to it over an extended period. You ride out the market's inevitable ups and downs without reacting to every little fluctuation.
Resisting the panic sell.
Totally. Our source, quoting ChatGPT actually, notes that investors who bought Bitcoin a decade ago and simply held on to the investment have enjoyed massive gains.
Yeah, the evidence is there for the early ones.
It's like planting a tree, right?
Yeah.
And diligently nurturing it, patiently waiting for it to mature and bear significant fruit, rather than trying to harvest tiny shoots every single day.
That's a good analogy.
You're investing in the long-term vision and intrinsic value of the asset, trusting in its foundational design and growing adoption, rather than attempting to outsmart the market on a daily or weekly basis.
Indeed, patience is key. But what elevates buy and hold for Bitcoin, perhaps beyond just any other growth asset, is its fundamental programmatic design.
Okay, what do you mean by programmatic design?
Well, unlike a traditional company that can decide to issue more shares, potentially diluting existing ownership, right?
Happens all the time.
Bitcoin has a hard-coded finite supply. Only 21 million coins will ever exist, period.
That scarcity factor.
Exactly. This absolute scarcity is a core tenet of its value proposition. And furthermore, this scarcity is reinforced by what are known as halving events.
Ah, yes, the halvings. I've heard about those.
They occur approximately every 4 years. And during a halving, the reward miners receive for validating new blocks and bringing new Bitcoin into circulation is cut in half.
So fewer new Bitcoins are created over time.
Precisely. This process systematically reduces the rate at which new Bitcoin is created, making it an incredibly deflationary asset over time. As global adoption grows, as more institutions and individuals seek to hold Bitcoin,
Demand goes up.
and as the supply of new Bitcoin tightens with each halving, the economic forces at play are uniquely set up for long-term value appreciation. Assuming, of course, demand continues its upward trajectory.
Right, that demand assumption is key.
It is. But it's not just about trusting a general upward trend. It's about understanding an embedded scarcity model that few, if any, other assets possess. Those massive gains the source points to for early adopters of this method weren't just about picking the right asset. They were about having the fortitude to keep it through thick and thin.
Through those scary dips.
Through periods where many others capitulated, truly understanding the underlying mechanics that supported that long-term vision. So this strategy requires a robust belief in Bitcoin's future role,
In fiction.
a high tolerance for temporary paper losses, and the discipline to avoid checking prices obsessively 5 times a day.
Guilty.
It's about recognizing that for most individuals, trying to time the market is a notoriously difficult, often losing game.
Okay, so the emphasis truly is on conviction over immediate gratification. A long game underpinned by Bitcoin's unique economic structure. That makes a lot of sense. But what if your appetite leans? Well, not towards the steady march of long-term growth, but towards the immediate, high-octane thrill of market fluctuation.
The other end of the spectrum.
Yeah. Our next strategy, day trading, is its complete antithesis.
Buckle up.
Now, for a stark contrast to patient accumulation, we turn to day trading. This approach is the complete opposite of buy and hold. It involves buying and selling Bitcoin frequently, often multiple times within the same day,
High frequency.
with the explicit goal of capitalizing on momentary price dips and then profiting as the price recovers or continues upward in the very short term.
Scheming profits off volatility.
Exactly.
Yeah.
Our source quotes ChatGPT again, stating bluntly that this is a full-time job if you take it seriously.
Not a hobby.
Definitely not. It's not for the faint of heart, and it explicitly demands two key things: technical expertise and an ability to buy on margin.
Two very significant requirements.
Yeah. When we talk about a full-time job, it implies a demanding lifestyle, right? Often requiring you to be glued to screens, analyzing charts, executing trades at lightning speed. That's a very high bar, wouldn't you say?
It's an extremely high bar, and it's vital for you, the listener, to understand the full implications before even considering this path.
No, sure.
When the source talks about technical expertise, we're not just referring to basic chart reading. We mean the ability to deeply interpret complex market charts, understanding various technical indicators that professional traders rely on.
Like what kind of indicators?
Well, things like moving averages, which help smooth out price data and identify trends, or Bollinger Bands. They give you a visual representation of price volatility and potential price extremes,
Okay.
signaling when an asset might be overbought or oversold. And the Relative Strength Index, the RSI, that's a momentum indicator helping determine if something's overbought or oversold based on the speed and change of price movements.
So a lot of analysis.
A lot. It's about deciphering market psychology and anticipating short-term movements through data analysis and pattern recognition. And then there's buying on margin.
Right. The second requirement. What's that exactly?
This means borrowing funds from a broker or an exchange to increase your potential trading capital.
Leverage.
Precisely. While it can dramatically amplify gains if your trades are successful because you're trading with more money than you actually own it equally, and often much more aggressively magnifies your losses.
The downside is bigger too.
It's much bigger. A small market dip, even just a few percentage points against your position, could wipe out your entire initial capital and potentially put you in debt to your broker. It can force liquidations you can't control.
Ouch.
It's a double-edged sword that demands extreme caution, meticulous risk management, and very precise capital allocation, not for the undisciplined.
It sounds like a grueling path indeed.
Yeah.
But for those who do succeed, I mean, the allure of quick gains must be undeniable. What separates the truly successful few from the many who falter in day trading Bitcoin? Is it purely technical skill, or is there like a psychological edge, maybe even luck?
That's an excellent question, and it's rarely just about technical skill. While mastering chart patterns and indicators is fundamental, the psychological aspect in day trading is absolutely paramount.
The mental game.
Huge. You need incredible discipline to stick to your trading plan, even when emotions like FOMO, fear of missing out, or panic selling are rampant all around you.
Hard to resist sometimes.
Very. You also need an almost detached emotional resilience to accept losses, because they will happen. No trader wins every trade.
Right.
The most successful day traders often have strict risk management rules, predefined stop-loss points that automatically close a losing trade to prevent further capital erosion. They understand that preserving capital is actually more important than chasing every potential win.
Protect your base.
Exactly. And the market for Bitcoin, being 247 and globally influenced, adds another layer of complexity. The sheer time commitment, often requiring you to be glued to screens during active market hours, can span global time zones.
No sleep for the wicked trader.
Pretty much.
Yeah.
The constant pressure, the rapid wins and losses, it can lead to immense psychological toll. It makes it a profession that truly few are built for. It's definitely not something to just dabble in. It demands full immersion and a particular temperament.
That makes a lot of sense. It sounds less like an investment strategy and more like a really demanding career path for a select few.
That's a good way to put it.
Okay, let's shift gears now to something less conventional but increasingly relevant, I think. A way to acquire Bitcoin earning platforms.
Getting paid in BTC.
Yeah. This strategy isn't about actively buying or trading in the traditional sense. It's about earning Bitcoin through services or products, essentially getting paid in crypto rather than traditional cash. Think freelance gigs, e-commerce, or even specific apps that reward you in Bitcoin for certain activities.
Like cashback, but crypto back.
Exactly. Our source mentions platforms like Bitwage, which facilitates crypto payroll for freelancers, and Lolly, which is one of those rewards apps that gives you Bitcoin back when you shop at participating retailers.
Interesting examples.
So what does this all mean for the everyday person? It means using Bitcoin as a currency in your work life and consumption, kind of blurring the lines between traditional income and digital assets.
This strategy points to a fascinating evolution in how we can interact with digital currencies. It helps normalize Bitcoin not just as an investment vehicle, but as a medium of exchange.
Making it more.
Exactly. It's a sign of increasing mainstream adoption. However, when considering the practicalities of this approach, you really need to think deeply about the implications of receiving your income in such a volatile asset.
Yeah, I was wondering about that.
Your earnings, denominated in Bitcoin, could fluctuate significantly in value from the moment you receive them until you decide to convert them to fiat currency or, spend them.
So you paid on Friday.
And by Monday, the value of that payment in terms of dollars or pounds or whatever could have dropped by 10% or more. Or, conversely, it could have gone up.
Whoa. That really makes you think about your payday differently, doesn't it? One week it's like a bonus, the next it's effectively a pay cut, all without doing anything differently. So how does one even budget with that kind of uncertainty?
Exactly. It presents a new paradigm for financial management. For those consistently earning in Bitcoin, it often means having a strategy. Maybe converting a portion to a stable currency like a stablecoin or just fiat for immediate expenses.
Rent, groceries.
Right. While perhaps holding on to another portion for potential long-term appreciation, treating it more like an investment.
A hybrid approach.
Kind of. The source also includes a very practical caveat right from ChatGPT. You'll need to drum up lots of business to get rich off of it.
Ah, yeah. Makes sense.
This isn't a passive income stream where Bitcoin magically appears in your wallet. It requires active work, consistent client acquisition if you're freelancing, or frequent shopping if you're using rewards apps. Just like any other freelance or e-commerce venture.
You're still trading time or effort for it.
Absolutely. You are actively exchanging your time, skills, or product for Bitcoin. If we connect this to the bigger picture, though, this strategy highlights the growing adoption of cryptocurrency in everyday transactions and the burgeoning gig economy.
Yeah, you see it more and more.
It signifies a future where decentralized payment systems could become more prevalent, maybe enabling faster, cheaper cross-border payments for freelancers and businesses. It pushes the boundaries of traditional employment and compensation models, moving towards a more direct and potentially globalized system of payment where the value of your labor can be directly tied to the performance of a digital asset. It's an interesting blend of entrepreneurial spirit and crypto adoption.
That's a big shift in how we think about a paycheck. Okay, now, for those who want exposure to Bitcoin, but perhaps aren't ready to jump into direct ownership, dealing with crypto wallets, private keys,
And technical hurdles.
or the high-stakes worlds of active trading, there's a fourth strategy, Bitcoin-related investment.
An indirect route.
Yeah. This is often seen as a less direct and, according to ChatGPT in our source, a less risky option compared to buying Bitcoin directly.
Relatively speaking.
Right. This strategy involves buying stocks of companies deeply involved in the Bitcoin ecosystem. Think major exchanges, mining operations.
Companies whose business relies on crypto.
Exactly. Or investing in exchange-traded funds, ETFs, that track Bitcoin's performance. For those of you who might be dipping your toes into the crypto waters, this sounds like a familiar investment vehicle, right?
Much more traditional, yeah.
It's a way to participate in the crypto market without actually holding the digital asset yourself.
Precisely. And what's fascinating here is that it offers a way to participate in the growth of the crypto ecosystem without taking on the full volatility or the technical complexities of holding the underlying asset directly.
So why is it considered less risky?
Well, the less risky aspect comes from a few angles, though it's important to understand this is relative. Risk is still present.
Of course.
Firstly, when you buy shares of a company like Coinbase or MicroStrategy, you're investing in a regulated entity with a defined business model, audited revenues, and often diverse services beyond just Bitcoin trading.
Right. They do other things too.
Yeah. Coinbase, for example, is one of the largest crypto exchanges, so its success is tied to the overall health and adoption of the crypto market. But it also has other revenue streams like staking services, institutional custody, a growing NFT marketplace.
Diversification within the company.
Exactly. And MicroStrategy, while it's a business intelligence firm by trade, has famously added a significant amount of Bitcoin to its corporate treasury. So its stock effectively acts as a proxy for Bitcoin exposure. But you're still investing in a functioning corporation with traditional operations and management.
Okay.
These companies have management teams, audited financials. They're subject to regulatory oversight,
Yeah.
which can provide a perceived layer of stability and transparency compared to the direct ownership of an often unregulated digital asset.
And what about those ETFs you mentioned? For those who are used to traditional stock market investments, how do those work with Bitcoin?
That's where the familiar investment vehicle really comes into play. When we talk about exchange-traded funds or ETFs that track Bitcoin's performance, think of an ETF as basically a basket of assets that trades just like a regular stock on a stock exchange.
Like an S&P 500 ETF, but for Bitcoin.
Kind of, yeah. Instead of directly buying and storing Bitcoin yourself, which involves setting up a crypto wallet, managing private keys, understanding blockchain transactions, all that stuff.
Which can be intimidating.
It can be. Instead, you just buy shares of this fund through your existing brokerage account. Nice and simple. The fund itself either directly holds Bitcoin in secure custody, or it holds financial contracts and derivatives that track its price.
So you get the price exposure without the hassle.
Pretty much. It allows you to gain exposure to Bitcoin's price movements, its ups and downs, through a familiar, regulated investment wrapper. It simplifies access to the crypto market significantly.
Makes sense.
It's also often a way to diversify within a traditional investment portfolio, providing exposure to a new asset class through structures investors are already comfortable with. This approach could be an ideal entry point for those seeking a more traditional investment pathway into the crypto space, leveraging existing knowledge of equity markets while still gaining exposure to the burgeoning digital asset economy. It truly blends the established world of traditional finance with the innovative realm of cryptocurrency, offering a kind of hybrid investment solution for a broad range of investors.
Okay, we've covered a lot of ground today.
Yeah.
From Bitcoin's, frankly, jaw-dropping historical performance to the distinct strategies people employ to engage with it.
4 key approaches.
We've explored the patient buy and hold, the intense world of day trading, the innovative landscape of Bitcoin earning platforms, and the more traditional Bitcoin-related investments.
A good overview.
But before we wrap up, it is absolutely crucial, I think, to pivot to the often overlooked, yet arguably most important aspect of any investment discussion: the risks.
Couldn't agree more. Essential.
Our source material makes a very direct statement. No matter how you decide to pursue riches through Bitcoin, ChatGPT recommended being on the lookout for certain risks.
Clear warning.
But here's where it gets really interesting, because while our source highlights the importance of being on the lookout, it then explicitly states that it does not detail what those specific risks are.
Yeah, it just kind of stops there.
Right. It lists this recommendation, but then it simply ends the thought, leaving us with an open yet incredibly important question.
And that very absence of detail is perhaps one of the most important takeaways for you as a listener.
How so?
Well, the fact that the source mentions the recommendation to be on the lookout for certain risks, even without detailing them, it underscores their inherent presence and critical importance. It highlights that the responsibility for understanding and mitigating these risks ultimately rests with you, the investor.
It's on you to figure it out.
Exactly. It reinforces the idea that knowledge is most valuable when understood and applied, and that definitely includes understanding the potential downsides before diving in. We've discussed direct ownership, frequent trading, earning platforms, indirect investments, and each of these approaches carries its own unique set of considerations and inherent risks that you absolutely must be aware of.
So even when the source material doesn't spell out the exact risks, the very mention of them is like a flashing neon sign.
Pretty much, yeah.
It's an implicit call to action for the listener to do their own deeper research into what those specific risks might be for each strategy.
Yeah.
Can you maybe give us a rundown of the primary categories of risk that apply broadly to engaging with Bitcoin, just so people have a starting point?
Absolutely. Think of it maybe as a checklist for your own due diligence. The first and perhaps most obvious one is market volatility risk.
The big one.
Yeah. Bitcoin is infamous for its dramatic price swings. While these can lead to significant gains, they can also lead to equally significant losses, sometimes in very short periods. And unlike traditional markets, crypto operates 204/7.
Never sleeps.
Meaning price movements can occur at any time, often reacting to global news or sentiment that you might not be actively monitoring. This applies to direct holdings, day trading, and even the value of your earnings from Bitcoin earning platforms. Your earned BTC could lose value overnight.
Okay, volatility. Got it. What else?
Then there's security risk. This is huge for direct holders. For those holding Bitcoin directly, particularly in self-custodied wallets, you bear the full responsibility for its security.
Not your keys, not your crypto.
That's the saying. It means protecting your private keys from theft, hacking, or even just accidental loss. If you lose your private keys, your Bitcoin is irrevocably gone.
Poof.
Scary thought. And centralized exchanges, while convenient, also present a security risk. They can be targets for hackers, and if an exchange is compromised, your funds could be stolen. Or if the exchange goes bankrupt, well, you might lose access to your assets entirely. That's counterparty risk.
Right, we've seen exchanges collapse.
Right.
Okay, security risk. Next.
A third major category is regulatory risk. This is a big unknown. The regulatory landscape for cryptocurrencies is still evolving and varies significantly by jurisdiction.
Yeah, it's all over the place.
New laws, bans, changes in how governments classify Bitcoin. These could dramatically impact its legality, accessibility, and market value. For instance, a country could ban crypto mining or impose strict taxation, which could send ripples through the entire ecosystem.
And that affects everything.
Pretty much, it applies to all strategies, as regulatory shifts can affect company stocks, ETF approvals, and the viability of earning platforms.
Okay, regulation. What's number 4?
Fourth, we have operational and technological risks. This can involve things like glitches or outages on trading platforms, smart contract vulnerabilities if you're engaging with decentralized finance or DeFi protocols.
Bugs in the code.
Yeah, potentially. Or even issues with the underlying blockchain network itself. Although, to be fair, Bitcoin's network has proven incredibly robust over time.
Pretty solid track record there.
It has. But for Bitcoin earning platforms, this could mean platform failures, withdrawal issues, or even outright scams. For Bitcoin-related stocks and ETFs, you also introduce company-specific risks. Poor management, competition, operational failures of the underlying business can affect your investment regardless of Bitcoin's actual price.
Right, you're betting on the company too.
Exactly. Finally, there's liquidity risk. While Bitcoin is generally highly liquid on major exchanges, its liquidity can vary, especially for very large transactions or during periods of extreme market stress.
Meaning it might be hard to sell quickly.
If you need to quickly sell a substantial amount of Bitcoin, you might not always find buyers willing to purchase at your desired price, potentially forcing you to sell at a discount. This is less of an issue for smaller retail investors, maybe, but it's an important consideration for larger players or institutions.
Okay, wow. That's an incredibly comprehensive and crucial breakdown. Volatility, security, regulation, operational tech, liquidity.
It covers the main bases.
It really paints a picture of the multifaceted nature of risk in this space, going far beyond just the price going up or down. It highlights that success isn't just about picking the right strategy, but about thoroughly understanding and preparing for these challenges.
Exactly. It encourages you, the listener, to think critically, to question assumptions, and to consider different viewpoints beyond just the potential for gains. There's always more to learn, right?
Always.
And multiple perspectives truly enrich understanding, especially when it comes to safeguarding your interests and making informed financial decisions. Understanding that whole range of potential risks is fundamental to truly unlocking any potential wealth rather than just chasing it blindly.
Yeah.
It's a proactive stance that distinguishes a well-informed approach from a purely speculative one.
This has been an incredibly insightful deep dive into the world of Bitcoin wealth strategies.
Right.
Really. We've unpacked its explosive historical growth, explored the 4 key strategies.
Buy and hold, day trading, earning-related investments.
Right. From the patient buy and hold to the intense day trading, from leveraging Bitcoin earning platforms to opting for Bitcoin-related investments. And we've underscored the absolutely crucial, though maybe undetailed in our source, message about being vigilant regarding a wide spectrum of risks.
Hopefully a good starting point.
Yeah, you now have a solid foundation, I think. A true shortcut to being well-informed on this complex topic.
So while the potential for wealth with Bitcoin is clearly laid out, perhaps the most profound takeaway for you is not just which strategy to pick, but how you assess and mitigate the inherent risks, especially those that aren't immediately obvious. It raises the ultimate question. How do you balance the allure of potential gains with a robust understanding of the journey's complete landscape? It really comes down to due diligence, continuous learning, and recognizing that even in the most exciting financial frontiers, prudence and informed decision-making are your most valuable assets.
A powerful thought to leave you with. And as we continue to bring you these deep dives into fascinating, often complex topics like this one, your engagement truly makes a difference for us.
It really does.
If you found this discussion valuable, maybe consider hitting that subscribe button, leaving us a comment with your thoughts, or perhaps sharing this deep dive with someone who might benefit. Your support helps us immensely, boosting our visibility in the algorithm and allowing us to keep creating quality content like this.
We appreciate it.
We really do. Thank you for joining us on this deep dive. We hope this exploration empowers you to continue your own journey of discovery and make truly informed decisions. Until next time.